Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.
We're speaking now with Peter Marrone, Executive Chairman of Yamana Gold, one of the world's largest gold producers, and we'll be talking about all things to do with the macro situation for the gold market, as well as the latest company developments that investors need to be paying attention to right now. Peter Marrone, welcome back to the show. Pleasure to have you.
Happy to be here. Thank you for inviting me.
Good to see you in person finally at the PDAC in Toronto.
It's been 2.5 years. I'm happy to be back.
2.5 years. Anyone's done a live conference. I've interviewed several times over Zoom, but it's always better to have you in person. Second quarter guidance, give us a teaser.
Yeah, so our first quarter, we produced just under 250,000 ounces. We did all of that at a cost of just under $1,090 per ounce, all in sustaining costs. We indicated that we were within the context of our budget for the first quarter. Our first quarter is usually weaker than the quarters to follow. We have to remember that by the end of this quarter, we will have ramped up our Jacobina mine to its second phase expansion to 8,500 tons per day. So I think directionally, you should anticipate that we'll be getting more production this quarter than we got in the first quarter. And the good news is that it appears, we're not complete through the quarter yet, but it appears that we're taming the inflationary impacts.
Yes.
And so it does look as if we'll be within our budget for costs once again for this quarter. And that portends very well for what to expect for the year on our guidance, both for production and for costs.
You mentioned that costs have risen modestly, not dramatically, modestly. What portion of your costs have risen the most due to inflationary pressures?
Well, interestingly, so far this quarter, again, we're not complete the quarter. We still have a few more weeks to the completion of the quarter. But so far this quarter, we're actually seeing costs that are lower this quarter than last quarter. So,
how is that possible, Peter?
Well, because we're producing more, because we're in a position to be able to say where there is the risk on cost because of inflationary pressures, we also have some levers to pull, buttons to push that allow us to be able to get a little bit more production. Where are we seeing the inflationary impacts? Clearly on things like diesel, that's an important one, but we're not very reliant on diesel. It represents 5-6% of our overall costs. So while we're seeing a little bit of inflationary pressure on some of the inputs, we're outputting more production, which means that our overall cost per ounce of production is lower.
Give us a guidance on your EBITDA margins. Have they been shrinking, expanding, the same as last quarter?
Our EBITDA margin should be better this quarter than they, again, directionally, better this quarter than they were last quarter, as a result of the fact that those additional ounces of production are coming from some of our lower cost mines, including Jacobina.
Interesting. I did want to ask you, a major theme of our discussion, or my discussion with a lot of miners at the conference, is how to combat inflation from the mining side. And I think you've answered most of that just now. It is very difficult for the industry to expand margin-wise at a time when costs are going up all over the place, including labor, including oil and gas, including raw materials, at the same time as gold flatlining over the last couple of months. And so your overall corporate strategy right now to combat shrinking margins, how would you summarize that?
Well, I would start by saying that I'm not convinced in the narrative that says that the margins will shrink because cost pressures will be there while gold price stays flat to perhaps even lower. I think that we're in this perfect storm of events that gold price goes significantly higher. This is so reminiscent to me of prior periods. Economics does not drive this, it is history. And if one looks at historical references, the closest presently is what happened in 2008. Let's remember that at the end of 2008, gold price actually declined from about $1,050 per ounce all the way down to $750, $740 thereabouts, and the equities took it a bit on the chin as well.
Yeah.
In moments of uncertainty, geopolitical, socioeconomic, it's not unique that we will be treated like other equities, and it's not unique that gold price will be flat to down, but that is temporary. We are in the middle of these geopolitical events, these socioeconomic events, and the result of all of that is that it gives me impressive, a positive view that gold price goes up.
Okay, tell us about this perfect storm. Some of the indicators you're looking at, you mentioned that you've seen similarities with 2008. Can you be more specific?
Similarities to 1980. So we're in the middle of a kinetic war in Europe.
Yes.
When was the last time that occurred? We're in the middle of what appears to be an economic war as a result, using the US dollar effectively, weaponizing the US dollar. We're in the middle of what appears to be a food crisis, and that will likely get worse as time passes. A lot of the fertilizer product that is produced in the world that allows crop yields to improve comes from that part of the world. And we're also in the middle of what appears to be a significant inflationary event. And that inflationary event coincides with many countries in the world that are now likely going to fall into recession. That term that's used, stagflation, is a good term perhaps. Okay. And so in the context of all of that, history tells us that gold price does well and the equities will follow.
Do you believe that we are currently in a recession right now in North America?
I think that we're on the cusp of that recession.
Okay.
And I think that there's an inevitability that stagflation event will occur.
Gold's performances during prior recessions has been inconsistent. Over the last recession, the last brief recession in 2020, gold went down, sharp recovery thereafter. In 2008, gold went down with the equities, again, sharp recovery after. In 2001, gold actually went up a little bit. What I'm trying to say is, Peter, gold doesn't always do well during a recession, but it seems to do well after a recession. Would you agree with that?
Well, again, history is a reference point, but it's not always precise.
Okay.
The expression that history doesn't repeat, but it rhymes. So I don't know if it is a perfect analog.
Yes.
But what I would say is we're in an event happening today, or events happening today, that are at a point where it is more extreme than anything that we've seen for decades, many, many decades.
Right.
Again, I use the analogy of 2008. Perhaps a better analogy is 1980.
Yes.
We're in the middle of a recessionary period, in the middle of an inflationary period,
Yes.
in the middle of a war, the invasion of Afghanistan by the Russians, the Americans calling the Russians the evil empire. So there's a lot of similarity to what's happening in the world today to what happened then. And we saw what happened to gold price back then. And gold price at that time going to $840 per ounce, more or less, that's the all-time high. Because if we look at real dollars, that's about $2,700, $2,800 per ounce.
Over your career, you've operated during several kinetic wars. Iraq, Afghanistan, didn't directly affect your operations, of course, but are you seeing similar challenges now than back in 2003, throughout the 2000s? What challenges do you face as a miner when there's a major war going on, albeit in another continent?
We're not facing any challenges. We don't get any supply. There's no supply chain or procurement that comes from that part of the world. So we're very insulated in terms of our operations in the Americas, certainly North America and South America. So we're not seeing anything that can cause a risk to us as a result of all of that. But what I'm saying is that these are more severe events than we've seen for many, many decades. And that portends very well for gold. Gold is that insurance policy, particularly in inflationary times. Right. And that's certainly where we are today.
I know our conversation isn't focused on geopolitics, but let me just end this topic on this question, Peter. Put on your speculative hat. How do you think this war in Ukraine may end or may protract? I'm reading articles from Bloomberg this morning that should the Russians not pull out, or should a swift victory, decisive victory on either side not happen in the next coming months, that there could be a war lasting for 10 years or so. That's just one perspective. How does this play out? How does this affect the gold industry in particular?
Well, David, I prefer to think that I'm a student of history, but not professorial.
Okay.
It would be very difficult for me to say what are the avenues of exit, what are the possibilities. I see many possibilities, but I'm not expert enough to be able to say this is likely what will happen, or these are the only possibilities of what can occur. However, I'm in an industry that relies on gold price. We are price takers, not price makers, in the manufacture of the product that we make, which is gold. And so my view is, in the context of all of that, while a company should be prudent, it should be disciplined, making sure that it analyzes projects not at the spot price, not on the anticipation of gold price going higher, making sure that we maintain cost discipline, as we are doing, as we discussed a few moments ago. But equally, we should keep an eye on where gold price is likely to go, and I think it's going higher.
Well, let me give you a statement then I'll ask you if you agree with the statement or disagree. The notion that a protracted war would dampen economic growth in Europe and perhaps around the world, that would put pressures on the Federal Reserve to actually loosen monetary policy, which may or may not influence the gold market directly. A loose monetary policy, all else being equal, should be positive for gold. Would you agree or disagree with that?
Well, perhaps the way that I would describe it is that there are very limited things that central banks can do as a result of what's causing this inflationary pressure. Supply chain disruptions, a war in a part of the world that is causing further disruptions on some of that supply chain, on things that are important, such as food product, fertilizer for food that increases, as I mentioned a few moments ago, crop yield. So in the context of all of that, I think that central banks are going to be very limited in terms of what they can do. Very limited in terms of oil price. So a lot of what's taking place is the result of oil price and what that's doing to fuel prices.
Yes.
In my view, it is a challenge, I think, if you're a central bank to say, I can do the following things that will cause that to improve. Let's go further. The Fed balance sheet is almost $10 trillion.
Right.
I mean, it was 1/10 of that just a decade ago, or a little over a decade ago. Worldwide debt is at unprecedented levels. So imagine the scenario there when worldwide debt is at these unprecedented levels and worldwide economies are shrinking. It just seems to me that we're in this perfect storm where it becomes very difficult for central banks, including the Fed, to increase interest rates to a level that would tame inflation. And so at some point, they probably have to pull back or come to the conclusion that inflationary pressures are here to stay for longer than anticipated.
I will have to mention to the audience, we're speaking today on Wednesday morning, right before the Federal Reserve releases their meeting minutes. So we don't know exactly what they're going to do. It's anticipated by market participants that a 75 basis point increase should happen today. Again, we'll see and watch for the news. But just looking ahead, you're saying that the Federal Reserve and central banks around the world cannot be in a position to raise rates significantly over the next 48 months or so?
That is what I'm saying, yes.
Okay.
I think it would be very detrimental to the ability of governments to pay debt and individuals and corporations to pay debt. And so I think that they would be very limited in their capacity to increase interest rates to a level that would tame the inflationary pressures that we're seeing.
So you would disagree with the notion that rising interest rates would dampen the gold market?
Well, I would agree that rising interest rates can dampen the market.
But it won't.
But it won't, because I think that there's a limited capacity in what the Federal Reserve and other central banks can do.
Okay. What is the relationship between oil and gold, particularly for a miner? I'm sensing a conflict for what the miners want. On the one hand, inflationary pressures could partly be contributed by rising energy costs. And inflation, as we know, over the long run should be positive for gold. On the other hand, rising energy costs should, in theory, put pressures on gold miners on the sustaining costs. So do you, as a miner, want higher oil or not?
Well, in our case, it's limited. As I mentioned, our dependence on fuel, its impact on our costs is about 5 to 6%. So that is not the issue. The issue that has a greater impact is labor. That represents about 40 to 45% cumulatively in our company and likely other companies as well. So where we have to maintain a discipline is because we're paying workers in local currencies, we have to make sure that we're maintaining a discipline over the possible appreciation of those local currencies. Yes. And that's where I think the emphasis should be.
All right, I want to come back to your gold price forecast because you did mention it's going to go significantly higher, but we'll save that to the end. I want to talk about your company's stock price. 35% up year to date, which is a very impressive feat considering that the Van Eck Gold Miners ETF I'm looking at right now, the GDX index, is up only 1% over the same period over the last 6 months. First of all, congrats. Second, how would you attribute this outperformance to?
It's years in the making. These things.
I mean, this is not a minor outperformance. It's, 30%.
And I think there's more upside, but it's years in the making. It comes from making sure that we have a proper portfolio of the quality assets that we want, making sure that those assets have the ability, as we mentioned a few moments ago, to perform a little bit better than what is forecast in a budget. We want to make sure that we have limited impacts on our costs in that portfolio. We want to be in jurisdictions where there's mining friendliness, mining pedigrees, where it's a rules-based jurisdiction. We want longevity to the assets so that we can properly assess how to more effectively manage those assets. And it's the quality of management. So we've spent the last at least half a decade, certainly the last 5 years, in making sure that we improve our board of directors for oversight, improve our management for the purposes of making sure that we're managing the portfolio effectively, disposing of certain assets that we didn't think were of the quality of certain other assets, and then optimizing those assets that we thought could overperform.
Is asset diversification in the long term important to you? I'll give you an example, Peter. I've been talking to some people here at the conference, and a major theme is the electrification of the world. A major investment theme tied to that is EV metals and things like lithium, cobalt, nickel. base metals, precious metals, and key earth, rare earth metals around the world. Now, these metals are not currently under the focus of your company. Will that change in the future?
Not for our company. I think that we're perfectly comfortable being a precious metals producer. We do have an asset in our portfolio that has a significant copper content. It's one of the larger copper gold assets in the world. And we've always been comfortable having copper in the portfolio. But I think you have to stick to what you know, and you have to stick to the consistency of message and to the certainty of what you can deliver. Okay. We're a precious metals producer. We like copper in the portfolio. We wouldn't deviate from that.
Okay. Going back to your gold price now, you said significantly higher. What's a comfortable value for you?
It is very difficult for me to predict gold price in terms of precision and certainly time frame.
It's difficult for everybody.
Yes, but I go back to first principles.
Yes.
I do not believe that we have seen the all-time high gold price. We saw that in a period that is analogous to what's taking place today. As I mentioned, with geopolitical conflict, interestingly involving the same country that was there in 1980. We're in the midst of a period of inflation. We're in the midst of a period of uncertainty in terms of economic growth, in terms of GDP growth, the economies of the world. In the context of all of that, gold price went to around $840 per ounce in 1980. And one has to look at it and say, well, when it got to just over $2,000 per ounce, is that the high? And in terms of raw absolute, perhaps it is. But in terms of adjusted dollars, what does $840 in 1980 mean today? And that number is roughly $2,700, $2,800. And I certainly think that there is an excellent opportunity for gold price to go to those levels again.
Okay,
we are in unprecedented times, and that's important to understand.
I'll give you another perspective, Peter, and just to back up your thesis here. Back in the early 2000s, the gold price was around a couple $100 an ounce, depending on what year you're looking at. That steadily grew to almost $2,000 in 2011. We're looking at a 10x increase, 8 to 10x increase over the span of a decade. People have been telling me about a parallel now that we can draw from that period of time. They're saying over the next 10 years, gold will not just, you're looking at $2,700, $2,800. They're telling me about $10,000 over the next 10 or 15 years or so, just based on historical growth rates of the price of gold. What do you think?
Well, some of these people clearly have done more work than I've done in terms of where to expect gold price to go. I said earlier that it's very difficult for me to say this is where I think it will go. Yeah. Look, I think the important thing is this. Right. You talked about it before. Maintaining margins, making sure that we can compress our costs and keep a control over those costs, a discipline over our costs in a period where gold price is presently flat. But let's not overlook the fact that several years ago, as recently as 3, 4, 5 years ago, gold price was well below where it is today. Yes. So if we can maintain the cost construct that was there 3 years ago, 4 years ago, and gold prices even at $1,800, then our margins have improved dramatically since 3 years ago. And in my view, David, that is why our share price has been performing as admirably as it has this year. Yeah,
considerable outperformance versus not just the GDX, the index, but also stocks at large. Also the gold bullion, and that's very impressive. People have been telling me that perhaps the gold sector, generally speaking, is a leading indicator for the gold price, and that certainly looks pretty dismal to me if you just look at the index, but certain outperformers might be an outlier. Let's circle back and end on the M&A landscape, and I believe you have some company developments you can share with us first.
Well, we're in the middle of a corporate transaction. We announced a couple of weeks ago, it's a couple of weeks ago yesterday to be precise, that we had engaged in a friendly transaction, a corporate merger between ourselves and Gold Fields. Gold Fields is a company that produces roughly 2.4, 2.5 million ounces per year. It is one of the leading companies in the world in terms of its competencies and capabilities. Here's a company that's existed, I think, going back to 1887. It has impressive experience at dealing with many of the geologies that we deal with. An example of that is our Jacobina mine in Brazil, which is a conglomerate reef construct very similar to what they have in Western Africa. But they've been doing that in Western Africa for the better part of 25 years, maybe 30 years, so certainly generational. And we've just started to scratch at this conglomerate construct at Jacobina. They have underground experience, deep shaft underground experience in South Africa that is very apropos to what we're doing in northern Quebec. And so it looked to us as if it was an excellent fit where we are creating a company that will become amongst the 3 or 4 largest precious metals producers in the world. That's the entry. We enter this elite club of world-class, top-drawer producers. But that's just the entry, David. The important thing then is when we compare ourselves to the other companies, those elite companies in that elite group of the senior producers, we have more growth, but at low capital cost, so very disciplined capital. We have better free cash flow conversion from cash flow and from revenue. So in other words, we generate better margins and we generate more profitability. And we have a true value proposition because even with a combination of the two companies, the cumulative market capitalization would be lower than those 3 companies. And adding to which is that we also have longer life.
Yes. Okay. You also engage in exploration yourself, your company. Why did you choose to partner with another company? Why not focus on just exploration is my question.
Well, we continue to focus on exploration. But
Let me rephrase, solely focus. Put all your capital on just greenfield, not acquisitions, not partnerships.
We are engaged in a transaction where an arm's length third party, after many, many months of diligence, the better part of 7 months of diligence, came to the conclusion that the market was not properly valuing our company. And so they offered a premium for our company, but we looked at it as that's the entry into a deal. That premium reflects a proper allocation of net asset values. What they contribute and we contribute is in line as a result of what they are prepared to pay for our company. But now we're looking at it and saying, now what does it create? Right. And as I mentioned a few moments ago, when you enter that elite club of the senior producers, but you're better than the senior producers on longevity, you're better than them in terms of free cash flow generation and margins, and you're better than them in terms of growth, disciplined growth, and you represent that value proposition of your market capitalization to theirs, I think that that's a win for all shareholders, Goldfields and ours.
Generally speaking now in the current macroeconomic environment, would you, I'm just talking about now, not just in general, but just now, would you prefer to, if you had the choice, deploy capital to more greenfield exploration right now or an acquisition of an existing project?
You know, I think you should be open to all of the possibilities that deliver value. Okay. So again, in the context of this transaction, this goes back to late 2020. Our board of directors and management came together and said, let's look at the landscape and how should we be positioned in the landscape. You are aware that I've been a big proponent of consolidation in our industry, going back the 19 years since I took this company public. And we've been a consolidator in the industry, and now we're looking at it and saying, this is a different form of consolidation where we're actually being absorbed into a larger company rather than what we've done in the past. So I think the best way that I can answer your question is that the best way to deliver value is to say, be open to all of the possibilities on maximizing value for your shareholders.
I'd like you to address this criticism by some fund managers of junior miner companies. And this is not directly directed at you per se, but all senior miners at large. Their view is that senior producers really should not be engaged in any greenfield exploration at all. Leave that to the explorers, leave that to the juniors, leave that specialization to that sector, and all you have to do is acquire them.
Well, it's an interesting point, and that has been historically what's taken place. And I would argue that we are, the size of company that we are, we're still very relevant in terms of being able to deliver greenfield results on exploration. We've demonstrated that. We can increase proven and probable reserves. We can make new discoveries. We've certainly evidenced that over the 19-year history of this company, and in particular, closer to present day, the last 5 years or so. But I think I agree with the premise that as a company becomes larger, the efficiency on exploration decreases. And I notice that with some personal investments, where I'm making investments in some of these exploration companies, and their ability to drill cost effectively is far better than a lot of the senior companies. And so in some respects, I think I share that view that was historically there, if we go back maybe 20 years ago, where the seniors should keep a focus on some of the exploration companies. And as they get to a certain point where they've demonstrated that there's something there, at that point they should acquire them.
Finally, what's your dividend policy now? Are you planning to change it going forward?
Well, the dividend policy that we have is we have a philosophy on the dividend, not a hard-coded policy, but we've increased our dividend more than 500% over the course of the since 2019, and we've paid roughly 1.1 billion of dividends since late 2006. So it's a pretty significant amount considering the market cap and size of our company. So we're certainly committed to the discipline, the financial discipline of paying a dividend. Interestingly, our partner in this business combination does have a formula. They pay 25% to 35% of their earnings on a dividend. And this transaction, interestingly, actually allows the combined company to be able to say, we can more comfortably go to the higher end of that dividend for longer.
Okay, interesting. Well, Peter, final question. Personal endeavors, what are you planning to do outside of company time? Are you planning to start another project on your own? Are you planning to raise a charity, do some philanthropic work? What's next for Peter Marrone?
Well, the summer is coming up, and I have young children.
Okay.
And I think my first priority is, right now we're in the middle of this corporate deal, get this corporate deal done, and spend a little bit of time with my young children.
Great. All right, Peter, good to see you again.
Good to see you.
And thank you for being here. Thank you for watching Kitco News. We'll have more for you. Stay tuned.
Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.